All right. Today is Tuesday, the 6th of May. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. This is the number one financial show on the planet right now, at least quality-wise. But hey, maybe I'm biased, who knows? Anyways, do you remember these kind of headlines that we got last year because all of the talk was soft landing? Oh, the recession has been avoided, inflation is dead. We got headlines like this from fake news Reuters. It says what's happening in Las Vegas shows Fed's soft landing is a good bet. That was in September 24, before the Fed, of course, made the jumbo rate cut, and then everything went downhill. We had inflation, and now, forget about downhill. Now we're falling off a cliff. So let's talk about it, and here it is, in focus tonight. Warning! The City of Lights turns dark. What is this, Batman, Maverick? What are you talking about turns dark? What we're talking about is the gaming revenue in Las Vegas. There's an alarming trend beginning to build up here. But most importantly, you have to, for folks who don't know, the Las Vegas indicator is one of the most spot-on leading indicators to the economy. What happens in Vegas doesn't stay in Vegas, believe it or not. What happens in Vegas spreads around the country right away. And I'm not just talking about syphilis and gonorrhea. I'm talking about economic developments. So, when we look at the year-on-year gaming revenue for the year so far, we got fresh numbers for last month, though. This is before the tariffs. So things might have gotten worse in the month of April, but we don't know yet. But here's the trend for you. You look at the gaming revenue in Clark County, which includes Las Vegas. In January, we had 13.3% increase in gaming revenue. February was a bad month across the board, by the way. We got a decline of 9.7%. Comes the month of March, which is supposed to be good. We're actually down 1.8%. What's interesting is in the month of March, gaming revenue was actually up in downtown, and it was up in the Boulder Strip, meaning that the local casinos did pretty good. But the Strip casinos, the gaming revenue was down 4.8%. And for folks who don't know, within Vegas, so we said Vegas, what happens in Vegas doesn't stay in Vegas, it spreads around the country, and we have within Vegas what happens in the Strip does not stay in the Strip. And what you see in every downturn in the economic cycle is the Strip slows down first, and then you see the local casinos getting hit too, because slowdown in the Strip means less jobs, means more economic uncertainty, and the locals begin to stop spending and gaming too. We are already beginning to see a touch of this recessionary development that we see in Las Vegas. Visitors go down, revenue goes down. Well, guess what follows? If you said layoffs, the answer is right.
Reports of layoffs at various Las Vegas casinos over the last several months leave some people asking why the workforce is being reduced when the overall demand for the city remains strong. LVRJ Casinos and Gaming reporter David Danzis weighs in on several factors driving the cuts.
One of the key drivers for staffing adjustments for casinos is actually what customers are telling them. Customers are no longer willing to pay some of the higher prices being charged in Las Vegas, but there's also larger concerns for travelers coming into the States as well as into Las Vegas, and they just don't have as much disposable income as they did in the years coming out of the COVID-19 pandemic.
The total number of casino layoffs in recent months is unknown, but does not yet appear to be statistically significant.
So again, it's not at the alarming level yet, but it is, shall we say, a negative development in the trends that we see, economic trends that is, in the city of Las Vegas. I think it's going to get worse. But you know what the worst part of it is? Because you got to remember, a lot of you lost jobs. Maybe you remember somebody who lost jobs back in the financial crisis. Forget about COVID. That was a fake panic anyways. We go back to the financial crisis. Folks lost their jobs in a big way. And we thought back then that the corporations were evil in the way they laid off employees. If you remember the movie with George Clooney, Up in the Air, of course, your company didn't have the balls to face you and say, hey, you're fired, and here's what we're going to do. Thank you for your service, but this is what we have to do. They actually outsourced the laying off process to other companies. Now, of course, the layoffs happen via an email. They don't even give a shit. A text, and you find out that you lost your job. But they add insult to the injury. Nowadays, when you get fired, your company doesn't say, oh, we have hard times, so we're really thankful for the employees, but that we have to let them go for cost management, etc. Now they actually celebrate layoffs as somehow a good thing. Oh, it's increasing efficiency. It's part of the new direction that we're taking. Take a look.
Area 15 is announcing layoffs in the company as it evolves into the Vegas immersive district. The company announced restructuring today. The big change, the New York-based COO, Dan Pelson, is leaving to be replaced by a Vegas-based native. The company says the decision supports Area 15's vision and core strengths. There's no word on how many other people are being laid off.
I'm Shauna Kalafi at the First Alert Update Desk. We've confirmed reports of layoffs at Resorts World. The hotel says less than 50 full-time employees are being laid off as part of a decision to restructure part of their operations. They also say this is part of efforts to optimize efficiency and maximize the guest experience.
So that sounds like bullshit, right? We're laying off employees to increase the core strength of the company. Which is, bullshit. What core strength? You're laying off employees. The other one says, we're going to improve the guest experience by getting rid of employees. In reality, folks, they're getting hammered because business is not good, number one. Number two, in the case of Resorts World, they actually got fined $10.5 million because they got caught money laundering. But folks, we're just scratching the surface here on how bad the Las Vegas economy is about to be, and of course, what follows is the national economy. We're going to go local now. Listen to our local news talking about the new numbers that we got about visitations to Las Vegas, which is not looking pretty good. Take a look.
Thanks, Ken. All right, Las Vegas is as big as it is right now because of tourism, right? It's always been that way.
Yeah, and lately the driving force behind our economy is slowing down. Fox 5's Mike Allen is here to break down the latest numbers. Good morning, Mike.
Well, good morning, Alyssa, Jason. So the latest tourism numbers from LVCVA are showing declines across the board. The big number we're looking at as we pop up this graphic I just made here, it's the top one that I have listed. It's about an 8% drop in overall visitors to Vegas. Airport traffic is down about 4%. Gaming wins are down too by almost 2% in Clark County. Interestingly, digging into that number a little bit, all of those gaming revenue losses are on the Strip. Everywhere else in the valley, like downtown, North Las Vegas, the Boulder Strip, those all had revenue increases. Another notable piece from this is that convention attendance, that's the last one there, it's up by about 10%, but that's helped a lot by the fact that a huge healthcare conference was held here just last month as part of a rotation of other cities. So next year we won't be getting that. And Jason, Alyssa, the way I'm reading this data, that last figure actually makes the situation worse. It's a 10% increase, but a lot of our visitors are here for conventions, which means they're here for work. It actually makes up 15% of all visitors. And since that is where we saw the only increase over the last year, it means the share of people actually choosing to come to visit Vegas to do that outside of work, it's even lower than you might think. So when you see that 8% decrease, you guys, the number really is a little bit lower than that in terms of people who are using their what's called discretionary income, right, to come here to Vegas.
I mean, yeah, we can only hope that while they're here for work, they still do use some of that discretionary income while they're in town, even though they didn't choose to come here per se. But these numbers coming from the LVCVA, which is typically pretty bullish on how Vegas looks for the future, are they blaming this drop in numbers on anything in particular?
It's pretty clear, actually, yes. In their summary of this report, they specifically point out President Trump's tariffs as part of the reason why this past March was slower than last year. And one thing we can say about that for sure is that we are seeing quite a bit fewer Canadians visiting, less international traffic overall. And you guys, Canadians make up more than half of all international visitors. And right now, we just saw yesterday a huge rebuke of President Trump in the Canadian election. Right. Probably going to see fewer Canadians moving forward, at the very least the next few months.
I've seen a lot online about Canadians boycotting Vegas.
Yeah, there's at least one big convention I knew about that they pulled out. That was supposed to bring in a lot of money. So, yeah, and then on the flip side, you were saying that like the gaming numbers in the city, you know, not on the Strip, are up, and that kind of makes sense too because our population is going up. And a lot of those people, I remember when I first moved here, I was always, I mean, I still kind of do, but you know, I was like really gung-ho about playing this and playing that and getting out and enjoying what Vegas has to offer.
And that's your local spot.
The locals, oh yeah, no, it was local.
And actually, I was able to find out, this is an unofficial number, but it seems like about 20% of that off-strip gaming numbers that are going up. That revenue actually comes directly from you, Jason.
You know what?
So a few interesting findings in this report. Number one, we talked about the difference between local casinos and the strip casinos. The locals are okay right now because for the most part, the economy is still intact. So they're going on. They're Californians who moved here with a lot of disposable income. They're using the income to go gamble and have a good time in the local casinos. But soon enough, word from the strip is going to begin to spread that, wait a minute, we have weakness, meaning that you gambling at the local casinos, you could be losing your job next. And that's how we end up in an inclusive decline in gaming revenues in Clark County. But the other finding is, you saw when they showed you the numbers, visitors down, all of that, but the conventions, the conferences, the attendance is higher. But they say, of course, the increase in the number of visitors for conventions was because of a healthcare conference that took place last month. And I can attest to that because Las Vegas is a great illustration of what's happening in the economy. So we talk usually about the consumer, right? The affluent consumer in the economy is doing fine. The tech workers, the spoiled brats with mommy and daddy's Amex card, you know the deal. You know, the parents, they give their kids rental properties and Airbnb and free cash to buy cryptos or whatever, and then they wonder why their children are fuck-ups. But in any case, that kind of class is doing okay. And anything that caters to that class of consumers in Las Vegas is doing phenomenal. Anything that caters to the rest, not doing so hot so. And you see the same thing in the corporations. So right now, visitors to Las Vegas, consumers, that's down. But corporations spending and holding conferences and holding conventions, that is still going on. And the fact that it was a healthcare conference is also reflective of the jobs data that shows that the healthcare sector remains extremely hot, with jobs being created, with spending going on. And the reason is the aging population that we have. But it ain't just healthcare, to be honest with you. 2 weeks ago, there was the car wash convention or conference or whatever. And there was about 20 to 25,000 car wash people were visiting here, which I thought was kind of suspicious. I mean, what are we talking about here? Car wash, money laundering, wink, wink, what's going on? And these car wash motherfuckers are crazy. They're the loudest. Talk about cocaine, hookers, getting drunk all over the casinos, all over the place, puking all over the place. Some wild parties at the car wash convention. But the other point from the report is when he talked about Canadians. So Canadians, half of the tourists who come to the U.S., and the Canadians hate our guts right now because we have a trade war, and we said we're just going to take you. We're going to take Canada, annex, to make it the 51st state. Of course, the Canadians are saying, well, you got to beat us in hockey first before you beat us in actual war or take it over. But it didn't bode pretty good. For some reason, that comment about annexing Canada really hit a negative tone with the Canadians, pissed them off big time. And they're not coming here. Whether you have a trade deal or no trade deal, because of this administration, they're not coming here. And we're going to lose revenue. Airbnbs, hotels, the Las Vegas casinos. Everybody's going to lose money from Canadian tourists not showing up here. And of course, today the Canadian PM visited the White House, and we all seen the pictures, the videos from the Oval. And of course, Trump was saying, as a real estate developer, everything is possible. I mean, we could buy Canada. And then the Canadian PM said, because he had to. And he says, it's not for sale ever. Get it out of your head. And it was kind of humiliating, to be honest, to the president, because he talks big and then comes face to face with the Canadian PM and he says, won't be for sale ever, and he just makes a face. Oh, we didn't really mean that we're going to annex Canada. We love Canada. Oh, did we say that we're going to have a trade war? And we love China. So why create the problem to begin with if you're going to pussy out or extinguish it later? But anyways, it ain't just Canadians, folks. Matter of fact, tourists from all over the world are saying, yeah, no thanks, we're not going to come to the U.S. Part of it, of course, the trade war, part of it, the administration, but a huge part of it is also the fear, because we've heard a lot of stories right now about tourists being detained at U.S. airports, a lot of them denied entry, a lot of them being kicked out right away. So you have not just Canada, but even European nations are now issuing warnings not to visit the U.S. And I have an Australian friend, for example, who came in here recently, and they got denied entry and sent back. Why? Because they had an Airbnb reservation that was canceled, and then they decided to stay with a friend in a visit. And the customs, of course, looked at that as, oh, they don't have hotel reservation. That means they're intending to stay, whatever. And they just denied them entry. And again, if you're a tourist, you don't want to spend all of that money and all of that time just traveling here to be kicked out. Sometimes for stupid and ambiguous reasons that are not explained. Sometimes because you have a certain tattoo. Recently, we have German tourists who got detained for weeks and then deported from the US. So it ain't just you're being detained at the airport for 24 hours, then they kick you out. Sometimes you go in detention here in the US for weeks, which again, scaring a lot of tourists from coming here. So you see visitations from France, from Germany, Italy, Spain, China, Korea, Japan, everything, everywhere, Australia. All of them are not coming here anymore, with the exception of the Brazilians, a little tick higher. But all in all, you see the international tourism already flipped. Now it appears that we're breaking the bullish trend since the pandemic. We're about to head down. Monthly international visitors arrivals to the U.S., that's heading down. So if you thought that the problem in the Las Vegas Strip is bad now, it's about to get worse because the visitors are not going to come. And the affluent consumer can keep some resorts open and some resorts going on. But all in all, it's just that weakness that we see in the Strip will spread all over. And then soon enough, it's going to hit the country too. Keep that in mind. But why is that the reason? Why do we call the Las Vegas indicator one of the most spot-on leading indicators for the economy? Because gaming is considered to be not a necessity. Gaming is a reflection of excess. When folks have excess money, they want to travel to Vegas and pay insane amount of money to stay here and gamble and do all of that. But once you have tough times and changes of psychology among the consumer, the first thing that they cut is Vegas. Can't afford it anymore. And if you thought that we might have some trade deals and things will get better and the tourists will come back once we get resolutions and deals, well, guess what? Today in the White House, Trump pretty much said, forget about deals. We don't even want to do deals. Take a look.
I wish they'd stop asking, how many deals are you signing this week? Because one day we'll come and we'll give you 100 deals. And they don't have to sign. All they have to do is say, oh, we'll start sending our ships right now to pick up whatever we want or to bring whatever we want. It's very, very simple. And I think my people haven't made it clear. We will sign some deals, but much bigger than that is we're going to put down the price that people are going to have to pay to shop in the United States.
First of all, I don't understand what he just said. Be honest with you. Like none of this really makes sense at all. And the other thing is, once again, if you're going to use tariffs to compensate for tax cuts, then the tariffs are not going away. So all of this talk about deals, what are we talking about here? And then he says we don't have to sign deals. I mean, it's a mess. It's all over the place. And Scott Bessent came out in the morning, by the way, and said we'd never talk to China. China never called. We never called China. Despite all of that talk, but we're actively talking to China and all of that. Take a listen.
We are currently negotiating with 17 of those trading partners. China, we have not engaged in negotiations with as of yet. But
of course, after the bell, because they know that tomorrow is going to be a disastrous day, because Jerome Powell is not going to cut rates, and the market is going to flush down big. At least was destined to flush down big. You saw the weakness Monday, Tuesday, and Jerome Powell, of course, coming out with no rate cuts and pretty much admitting that he's boxed in the corner and handicapped. That's going to freak out the market big time. So they come out with this fake news all the time. Oh, we're going to talk to China. We have a meeting in Switzerland with some Chinese people. Anyways, we're going to bring it up and talk about it. And that's, of course, intended to pump the market and mask the risks that we have. We'll see what kind of talks are they talking about, because we've heard of that before, and the Chinese made their position clear. No negotiations, no talks without pausing the tariffs. So for all you know, now we see the futures going higher based on this headline right here, that we have a meeting with China coming out later this week. For all you know, China could come out overnight and say we never really talked or we're not going to meet. I don't know what they're talking about here. So that makes trading the market absolutely insane. But here's what I got to say about it, folks. Deal or no deal, talks or no talks, negotiations or no negotiations, the damage is already in. We just talked about the tourists. I don't think that the tourists are coming back if we have a trade deal with Germany. They're not coming back. The Canadians are not coming back. So that damage is already done. I was in LA over the weekend. It was a ghost town. No tourists, nobody dining out. The restaurants are empty. And you see the strip outside of the casinos that cater to the affluent consumer. They're ghost towns too. The damage is already done. You saw what happened after the bell with AMD saying they will take a $1.5 billion hit to revenues from the restrictions of chips to China. So again, deal or no deal, do we really expect that we're going to at some point resume shipments of AI chips to China? Not going to happen. Not going to happen for national security reasons, of course, which is the main reason behind all of this. So what are we going to negotiate on? Underwears and Nike shoes? If we're not going to tackle the big elephant in the room, which is chip exports from the US to China. And the Chinese are saying, you know what, whether you give us the chips or not, we're going to develop our own. And Huawei already developing a rival in NVIDIA. Folks, I think we can play these cute games that we're going to have a deal with China and all of that. But at the end of the day, and this was, by the way, part of the destiny, that we're going to head the inevitable destiny. We were going to head this way with or without Trump. Because if you recall, the last administration was not so friendly to China either. Because at the end of the day, who rules our government is the deep state. And they want to ensure that China is not going to take over the United States in the 21st century. We want to remain the top economic, the top military power, the top country in the world, and we want to keep China as far as we can behind. So with or without Trump, we were heading toward decoupling from China. And again, all of this talk by Bessent after the bell about talks in Switzerland with some Chinese people from the consulate or whatever. All of that talk is just meant to trigger the algos and pump the market. But at the end of the day, folks are not really buying this rebound right here. It's mostly shorts. Retail participation is limited to certain stocks, and they're getting killed right now. And you saw what happened to Palantir. A lot of folks chased Johnny-come-lately before the earnings, and they got hit. And the shorts still not finding a reason to short again, but if the buyers don't show up, then the shorts will have to go back in the game again. So it's a negative dynamic all in all. And folks, when we talk about the damages done, today Goldman Sachs came out and said that if we have a deal with China, then the tariff rate will go down from 145%, which is we have right now. It will go to about 70%, which is again way higher than last year. So the damage is already done. What are you going to negotiate here? Cut the tariff rate by half? It is still higher than before. We're still going to overpay. We're still going to have worsening inflation, which will delay rate cuts and create more and more decay and damage in the economy. I mean, check out the trade deficit that we got today. The largest trade deficit in history. We've never seen anything like this before. I mean, the whole goal was to close the trade deficit. It's not working out pretty good right now. But an important finding, because we talked about front loading by companies, front-loading inventories, and then the consumer front-loading the demand before the tariffs hit. Today, we got alarming data because look at the heat map of the stock market. You see healthcare, you see all of these big pharma names getting absolutely creamed today. Matter of fact, the healthcare sector, which is, again, the number one sector that is responsible for keeping the jobs market alive. Well, the healthcare sector in the stock market got absolutely destroyed today, down about 3%. Why? Because when you dig down about all of the front-loading that happened, and the massive trade deficit that we got, it ain't because we were buying stuff from China before the tariffs, meaning that the companies were not really loading in inventories, and the consumer was not demanding and front-loading that demand from China. Matter of fact, demand went down in the month of March. What exploded higher is demand from Ireland. Now, what the hell does that mean? What has Ireland got to do with anything here? Well, it's the place that we hide our money in, so we don't have to pay taxes. The cheats, the corporate cheats like Apple and Eaton and all of these pharmaceutical companies, a lot of them are registered in Ireland, even though they're American companies, but they don't want to pay taxes here. And they manufacture the drugs in Ireland. So we all know that the pharmaceutical tariffs are about to be announced. Nobody knows how much, nobody knows what. But the big pharma companies are convinced, unlike, let's say, the retail companies, but they're convinced, along with the semiconductor companies, that even if we have trade deals, even if we remove the tariffs on Nike shoes or underwear or whatever, for national security reasons, the tariffs are here to stay. The restrictions are here to stay when it comes to semiconductors and pharmaceutical medicine. Now, by the way, I do agree that it is a national security issue and we have to manufacture this stuff right here. But I'm just explaining to you the economic impact from the phenomenon that we see right now. So turns out the majority of the trade deficit that we got, contribution to the trade deficit, not coming from China, coming from Ireland. Why? Because here it is. Imports of pharmaceutical products. They were bringing in all of that product from Ireland before the tariffs, so they can stock up in the medicine right now until they figure out the next move. And the way the market reads it is they've incurred a lot of costs to front load all of that inventory from Ireland. And whether the consumer will increase its demand to match the surge in inventory, that's not really guaranteed, number one. And number two, that's an extra cost in getting all of that inventory in. And then thirdly, of course, the uncertainty that comes after the tariffs are announced. Are they going to invest in building factories here and incur even more cost? So all of a sudden, in a sector that is supposed to be recession-proof and stagflation-proof, more than a recession, all of a sudden it lost its allure because of this uncertainty. And by the way, I mean, Ireland is going to get hit pretty hard at the end of the day. So if we look at the EIRL, this is the Ireland ETF. We're looking at the monthly chart. It looks to me that we're forming a bear flag within a topping head and shoulder, and the Ireland ETF might go down and revisit the trend line. If that is the case, you probably want to short Ireland. Now, let's revisit the conversation because there's a lot of talk about, maybe there's a trade deal with India. That's what Bessent teased a week ago. Of course, so far, we have no news about that. But the news that we got a few hours ago is India bombed Pakistan, and Pakistan is now vowing retaliation. Headline from Bloomberg says that Pakistan shot down 5 Indian planes and has taken some Indian soldiers prisoners, the country defense minister said, which sounds to be bullshit because if it is real, it'll be a massive embarrassment to India. But regardless, we have an escalation right here. Who knows if it's going to stop or become a more dangerous situation. But you look at INDA daily chart, this is the India ETF. It is cutting below the 200 days moving average. So if you're betting on a trade deal by buying INDA, well, until the deal is announced, and even if you get it, you might have to sell the news. And because of the war news that we just got, I think that INDA is going to head down further. It's not a place you want to be in right now. Perhaps you want to be in the EWY, the Korean ETF, because this one, INDA is cutting below the 200 days moving average. The Korean ETF is crossing above the 200 days moving average, and the reason is a lot of Korean investment funds and any foreign assets, specifically in the U.S., will be asked by the central bankers in Korea to bring back some of that assets. And the dollar will go down, the Korean won will go higher, and as we've seen with multiple examples before, be it Mexico ETF or Taiwan ETF, when the currency goes higher, so will the ETF. So I'd rather be in the EWY versus INDA. Now, if we do a check on commodities, because we talked about India, Pakistan, is there an influence on oil prices, where oil was higher today, about 3%, be it for Brent or WTI, but I don't think it's related to India, Pakistan. I think this is just a technical rebound, because the worst is behind us now. We've maximized the bad news. We can only see the resolution from this point on when it comes to OPEC+. But we also talked about other countries asking their investors to dump U.S. assets, U.S. dollars, and convert them back to domestic currency and domestic investments. That's leading the U.S. dollar to go down. It's leading to equities to be not a reliable performer or a hold right now. What's reliable, though, if you think that the dollar is going to continue to go down, is being long metals. You see gold up almost 3.5% today, silver up about 3%, platinum a little over 3%, copper above 1%, palladium almost 4% worth of gains. You look at it from a year-to-date kind of perspective. You got gold in yellow, of course, up about 25% for the year. You got copper in red up about 18% for the year. You got silver up about 13% for the year. You got palladium in blue up about 7% for the year. Meanwhile, we know that the equities market is down. The bond market is down. So perhaps metals right now make sense. And speaking of, let's do the technical analysis because we're going to look at the indicators and see where we stand. Reminder, the indicators for the rebound: Dixie stability, gold pullback, the VIX 2 hours MACD, which is now the daily, HYG trading above the 200, DMA crude oil trading above 64, 10-year yield trading below 4.3%, Bitcoin trading above the 200 DMA. We begin with the Dixie. Is the inverse and shoulder still intact? Yes, but do we see a little bit of weakening here in the dollar? I think so. I think that the FOMC is going to be really important in determining where we go next in the US dollar. And if we see more volatility, if Powell contributes to the volatility, because we're going to see volatility, that's inevitable, as we see more countries now converting dollars to local currencies. But if Powell screws up tomorrow and scares the dollar and we see a flush, that's going to be bad for the equities market. The dollar right now is what dominates the VIX, believe it or not. We don't see that often because the dollar is considered to be a staple, a reserve currency, a safe haven. Well, apparently not anymore. Then you look at gold futures. Gold was rallying higher, which was a bad sign because we need to see outflows from the defensive gold to ensure that we have inflows into risk-on equities. It wasn't looking good Monday, Tuesday, but overnight, because of the Bessent fake news pump that we're going to meet some Chinese in Switzerland. We're going to eat some Chinese food over there. We see gold going down, and we see equities futures heading higher. Nice pump for now, but I think the market will shift the focus to the FOMC tomorrow and the prospects of rate cuts. If they're delayed, we got a big problem. If we look at the VIX 2 hours chart, we still have the risk of an inverse head and shoulder pattern and the VIX heading higher again. But bear in mind that overnight, once again, the fake news of China is going to eat with us now. You see the VIX futures for the May contract at least kind of reversing. You see that daily reverse. It's not a bearish engulfing yet, but it lost a lot of the gains from today's session. That's a positive, of course, for the stock market. Then you look at the HYG below the 200 days moving average in yellow and below the blue line, which is the 50 days moving average. We'll give it the benefit of the doubt. If we see a pop above the 50 tomorrow, that's going to be positive. The rebound is still alive. If we cut below 78 after the FOMC, forget about it. HYG is suggesting that the equities market is going to flush down too. Now, when it comes to crude oil, and we talked about this in the stream today, we got a nice rebound. And if you made money from that swing trade, you can close it right now. You can close it tomorrow. It's okay. If you're just intending on a swing trade in crude oil, as I did. But you have to understand two things. When oil goes down and the market goes down with it, it means that we are in a recession theme. We're dumping crude and equities. Now, when you have crude going higher, but equities heading down, it says that the inflation fear is more dominant. And you got to remember that the recession fear has been more dominant for weeks now, as we've seen crude going down, bonds going down, and we've seen, of course, U.S. equities heading down. But we got the jobs number on Friday, which soothed all of the recession fears. And instead, now we're talking about, the ports are going to be empty. The shelves are going to be empty in the next few weeks. So now we're talking about inflation as the dominant fear. And this is why, despite the rebound that we've seen in crude oil, we've seen equities actually heading down. Because now we've entered sort of an inflation fear phase and left the recession fear phase behind us. So crude oil as an indicator alone can be deceiving. Keep that in mind. Now, when we look at the 10-year yield daily chart, we got the falling wedge breakout. But now after the news from Bessent, after the bell, you see that the 10-year is probably going to cut below 4.3. And if it does, okay, that's a net positive for the equities market. And Bitcoin looking pretty good still. You have a bull flag pattern. Didn't lose 92,000, didn't lose the 200 days moving average, but we know the momentum is peaking, as you can see in the MACD indicator. But unless it cuts below the 200 days moving average, you got to assume that the upside is still intact for now. If that is the case, then we have risk-on sentiment in the market, and that's good for risk-on assets. So you look at it all in all, in the E-mini futures 2 hours chart, what do we see here? Of course, our confirmation number is a loss of 5,600. You lose 5,600, then we have a resumption of the bear market. But right now, we got a rebound from 5,600, as we said in the morning brief today. We've lost the trend, though. So even with the pump that we got after the bell, we see a move higher, but it's still short of recapturing the trend line. So I think that we've done at least a little bit of a cover, but it's going to come in the lap of Powell. Powell is going to dictate whether the trend is captured or whether we go down to 5,600 and break 5,600, and then Bessent will get a nice pie in the face that you can pump all you want. It doesn't work anymore. We'll see. But let's segue to the conclusion of this video. What do we have in the economic calendar tomorrow? As we've been talking about throughout the program, the FOMC meeting and, of course, the conference by Chairman Powell. A lot of folks are saying what is important about the conference because, again, if he cuts rates, that's going to be the surprise. And I think it's going to be a negative surprise because everybody's going to ask why. Why are you cutting rates right now? You're afraid of a recession, right? And we should panic right now. So he's not going to cut. That's my opinion. I don't think he's going to cut. I think the consensus is he's not going to cut. What's really important if he's not going to cut, at least to the market, it will be how would the White House react to Jay Powell not cutting? Because Trump called him a stiff over the weekend, which is a hilarious attack. I think Jay Powell, that triggers him when he calls him a stiff. That pisses Jerome Powell off for some reason. But if he attacks Powell after the conference and he threatens to fire Powell or fires Powell, that's going to be an epic disaster. That's when the market is going to freak out. So the market right now is more worried about how would Trump receive the news that Jay Powell is not cutting. And then, of course, we have consumer credit, which is really important because the consumer is under stress. So if we see a huge acceleration in consumer credit, that's going to be bad news. What do we have on the earnings calendar? We have an important indicator for the economy, which is Uber. Disney is also an important indicator, at least their theme parks. We have other companies, important companies too, like AppLovin, like Fortinet, and you got Emerson Electric. You have JCI, Johnson Controls International. That's an important company. You have Carvana. Let's see how fraud is doing in this economy. And then we have Vestra, VST, an important data center play. So folks, we covered a lot today. Thank you for joining us. We'll be back again tomorrow, but this is all I got for you for now. Thank you for listening. Thank you for watching. I appreciate and love all of you. We'll be talking to you again tomorrow. Good night.
She shuts out the night. Guess the thousands waiting. She turns out the light, but it's too late. Too late. Too late. Too late. clown, they're waiting for their cue.